The S&P 500 index SPY has had a pretty terrible February. We can see it was trading as high as around $418 per share, but it's dipped all the way down to below 400 at around 397. And with that, I found two quality dividend growth companies to be at their 52-week low, and both of these companies are actually companies that I just recently added shares of to my dividend portfolio. So let's go ahead and jump into it. The first company that I added to my dividend portfolio was Domino's Pizza. This company is currently trading at $306.20 per share. We can see over the past year, they're down about 27.46%, but check this out. Over the last 5 days, they are down 12.95%, with a huge decline coming as they just recently released their earnings reports. Let's go ahead and dig into that a little bit. We can see revenue, there was a slight miss, $1.39 billion versus the $1.43 billion expected. Adjusted earnings per share, actually pretty solid, $4.43 versus the $3.97, but this next part is what I think kind of has the market a little bit spooked. US same-store sales up 0.9% versus the 3.64% expected, and franchise-owned stores up 0.8% versus the 3.4% expected. And again, I think that's kind of what's caused this little bit of a dip as we've seen in the share price. It's currently down around 12% on this trading day. Now, if you keep up with this company, you know the good news about this is they also just recently announced they're going to be increasing their quarterly dividend by 10%, which is going to give them a dividend payout of $1.21 and a forward dividend yield of 1.39%. Now, if you keep up with this company pretty closely, if we jump over to their dividends, you already know this, but if we look at their dividend growth, we can see their 5-year compounded annual dividend growth rate, pretty unbelievable at 19.5%. Let's go ahead and check out that dividend history. We'll scroll down. If we look at the past 10 years, we can see 10 years ago, they were paying out about 20 cents per share every single quarter. Jump forward to now, the most recent one was $1.10, and like we just saw, the next one will be $1.21. So let's go ahead and jump into my stock valuation spreadsheet to see if we can find the intrinsic value of Domino's. We'll be looking at 4 different valuations: grams, discounted cash flow, multiples, and dividend discount. And if you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in the stock ticker for Domino's Pizza and hit enter, and you can see all of this data is going to automatically load in. Now, as we already saw, this dividend data hasn't been updated yet. They just announced a recent dividend increase, and it's going to be $1.21. If we come down here, we can see analysts currently have a target price of $385 per share. Institutional ownership actually pretty high at almost 94%, and a fairly low beta at around 0.71. Now let's go ahead and jump forward and look at Graham's valuation. I'll come over here and zoom in, and you can see pretty strong earnings per share for Domino's, decent growth rate projection, but the current yield on AAA corporate bonds is currently very, very high, especially compared to where it's been over the past decade, and that's going to push down this intrinsic value quite a bit. Typically, over the past 3 or 4 years, it's been more around 2.8, and you can see when that's the case, this intrinsic value jumps up quite a bit to around $360 per share. So current market conditions are definitely pushing down this valuation quite a bit. Now let's go ahead and jump forward and look at our discounted cash flow analysis. Essentially, what we're doing is we're valuing the company based on how much free cash flow we expect them to produce in the future. So we need to project a growth rate to these future free cash flows, and to do this, I plugged in the historical free cash flow for the company so we can see our year-over-year growth rates. They've had an average growth rate of 19.59%. That's pushed up quite a bit by this growth rate right here, as you can see. But moving forward, I'm projecting a growth rate of around 11% for the future free cash flows, which is actually in line with analyst expectations. I also used 11% for the terminal value, which is the sum of the future free cash flows past the year 2030. I then found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, and subtracted out the total debt to get their equity value. Once I had that, I divided by our shares outstanding and came to a discounted cash flow price per share of $409.20, quite a bit higher than that current trading price. Now, jumping over to our multiples valuation, what we're doing is we're valuing the company based on how the market is valuing companies that are similar in structure. So you can see we're taking companies like McDonald's, Yum Brands, Starbucks, and Papa John's, taking their stock price, dividing by the earnings per share to get that price to earnings multiple. And you'll notice all of these companies actually have fairly high price to earnings multiples. That's kind of the standard in this industry. Average price to earnings of around 35.08. So when you multiply that by Domino's Pizza's earnings per share, you come to an intrinsic value of $434.71. And if we jump over to the stock screener, we can see Domino's price to earnings 24.77. So again, quite a bit lower than that average price to earnings. Moving forward and looking at our dividend discount model, again, they just recently announced that dividend increase, but I plugged in the quarterly dividend payouts, including the new increase, so we can see how much they're expected to pay out each year. This allows us to see our year-over-year dividend growth rates. Again, really, really solid history of dividend growth. That's an average growth rate of 16.88. Moving forward, I'm projecting a dividend dividend growth rate of 7.8, discount rate of 9%, and that gives us a dividend discount model price per share of $434.79. Now, anytime you project a growth rate that's fairly high for the dividend growth, there's two things you want to check. First, you do want to check to make sure you're expecting the company to continue to grow their free cash flow, which in this case, we've already seen 11% free cash flow growth. That's a check. Jumping over to our stock screener, we also want to check that payout ratio, and we can see the payout ratio is only sitting at around 32.5. So that's a nice safe payout ratio. So that dividend growth rate will probably be pretty safe moving forward. So jumping over to our output tab, you can see we have Grams valuation at 210, multiples at 434, discounted cash flow 409, and dividend discount model at 434. And so when we average all four of those together, we come to an intrinsic value of $372.43. Let's say we'd apply a 10% margin of safety. Based upon that, our acceptable buy price is $335, meaning it's a good time to consider adding this to your portfolio. With a 20% margin of safety, our acceptable buy price is $297.95. So it's not quite at that range, but it is getting very close to it. Again, I just added 3 shares of this to my dividend portfolio. Low starting dividend yield, but a phenomenal history over the past decade of really solid dividend growth. I think long term, this could be a good play. So maybe consider looking into it more and adding it to your portfolio. But let's go ahead and look at our other stock at a 52-week low. And the second dividend growth company that I just added to my portfolio and is also at a 52-week low is Johnson & Johnson, stock ticker J&J, currently trading at $157.05 per share. We can see over the past year, they're down about 2.59%, but year to date, it's really just been on the decline, down almost 12%. Now, the good news anytime a dividend stock is at a 52-week low is it bumps out that dividend yield. You can see the dividend yield sitting at around 2.86% for this company, which is actually the highest it's been in about 3 years. Now, the reason people really love this company so much is obviously its history of dividend growth. They've been increasing dividends for over 60 consecutive years, so that's a great sign. And when we look at the 10-year dividend annual growth rate, still sitting at 6.36%, that's a really good dividend growth rate for a company that's been increasing dividends that long. So let's go ahead and jump over to our valuation spreadsheet. We'll go ahead and come up here and plug in the stock ticker and hit enter. And again, this data will load in. Like we already mentioned, dividend yield of around 2.88%. Analysts currently have a target price of $183. Institutional ownership around 70.8%. And this is really interesting, a beta of just 0.54, so very low volatility from this company, which can really be a good sign depending on what you're looking for in your portfolio. But jumping over to Grams valuation again, this valuation is going to be driven down quite a bit by the fact that current yield on AAA corporate bonds has climbed so high. So when we plug in all of these variables, you see we still come to an intrinsic value of $74.34. Jumping over to our discounted cash flow analysis, you can see again we plugged in our historical free cash flow. Moving forward, I'm projecting a growth rate pretty much in line with the average growth rate historically, projecting a growth rate of 5.5% to the future free cash flow. After taking the present value of that, we get the sum of the future free cash flow, add their cash and subtract out the total debt to get the equity value, divide by our shares outstanding, and we come to a discounted cash flow price per share of $170.38. Now moving forward, looking at our multiples valuation, you can see we're using MRK and ABBV as our multiples. I didn't use Pfizer in this scenario for a few different reasons. I'm not going to dig into it too much in this video, but you can see we're using average price to earnings of 21.046. Multiply that by the earnings per share for J&J, and that comes to an intrinsic value of $141.64. So actually a little bit lower than these other companies, but I think in this scenario, you could definitely argue that Johnson & Johnson is going to be a company that trades at a premium for a few different reasons, but I'll touch on that in just a few moments. Moving forward to our dividend discount model again, you can see I plugged in the historical dividend payouts for Johnson & Johnson, pretty much in line with that 10-year rate of 6.6%. They had 5.56% dividend growth, 6.3, 4.95, and 6.6. So that's an average growth rate of about 5.86 over the last few years. Moving forward, I'm projecting a dividend growth rate of 5.5, discount rate of 8, and that gives us a dividend discount model price per share of $190.74. So jumping over to our output tab, you can see our 4 valuations, and at a glance, you can see the intrinsic value is actually only showing $144.28. So why did I add this company to my portfolio? And while I usually think Grams valuation and the multiples valuation can be a pretty solid way to value a company, I think there are scenarios where they're not quite as important as the discounted cash flow analysis and the dividend discount model. And I think this is actually one of those scenarios you have to keep in mind with Johnson & Johnson. This is considered a defensive stock. Historically, they've had a long history of increasing dividends. Again, like we mentioned, a beta of just 0.54. So there's going to be a lot of people during periods of economic downturns that turn to stocks like Johnson & Johnson because they know they can expect that safe and increasing dividend payout, not to mention that you'd be getting in with the highest starting dividend yield that we've been seeing in around 3 years. So I think if you were to remove Graham's valuation and the multiples valuation, your intrinsic value jumps up quite a bit to around $180 per share. I think that's a little bit closer to the fair value, and considering the fact it's at a 52-week low at its current trading price, may be a good stock to consider. Now, keep in mind you might not see as much growth or just dividend growth as a company like Domino's that we just looked at, but you are getting a very safe play, especially with the potential for economic downturn. So even with a 10% margin of safety, you can see your acceptable buy price of around $162 per share. It's right in that buy range. So I added just a few shares of this to my dividend portfolio. I think it's a decent play for most people. So there you go. Those are 2 dividend growth stocks that I just added to my portfolio. Go ahead and let me know what you think of these companies in the comments down below if you plan on buying or selling. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.